everyone, my name is Farhan. Today you will solve question number 5 from 2018 past exam. In this question, we will mainly do the depreciation and disposal of non-current assets in part C, and in parts A and B we'll do adjustments for expense and liability items and understand the effects on the accounting equation for these adjustments. You can see the question on the left hand side of your screen, and on the right hand side you'll see the workings which I'll go through and explain step by step. So with that being said, let's begin. VCE Computing sells computer products for cash and on credit. All stock is marked up by 100% on cost. The business reports on a monthly basis. The balance sheet as of 31 August 2018 is provided below. So you can see that we're given the balance sheet here at the end of 31 August 2018, and we're given the various current assets here and all the non-current assets, all the current liabilities, and all the owner's equity. Now, know that this question is from 2018 past exam, which refers to the all curriculum. And in that all curriculum, we used different terminologies. Debtors control are what we now refer to as the accounts receivable. Then we have got the stock control, which is what we now refer to as inventory. Then we have got the creditors control, which is what we now refer to as accounts payable. And then we've got the prepaid sales revenue, which is what we now refer to as unearned sales revenue. Now, the first part of the question requires you to record the following transactions in the journals. So starting with the 3rd of September. So on the 3rd of September, wages paid $4,500, and you can see the source document, which is check 340. Now, on the 3rd of September, we have paid $4,500 in total for wages. Now, if you look into the balance sheet that we have been given at end of August 2018, you'll find that under the current liabilities section, you've got the accrued wages, and that is $1,300. So this accrued wages of $1,300 from 31 August 2018 refers to wages expense that we have incurred in the month of August, but we didn't pay for it using our cash or bank balance, which means this was a current liability at end of August 2018. Now, on the 3rd of September, you have paid $4,500 in total for wages, which means this accrued wages, which happened before, will first be taken care of. Now, at end of 31 August 2018, we knew this was a liability. Now that we know that we have paid this off, we have to reduce this liability or reduce this obligation in our accounts. So how do we do that? We debit the accrued wages liability account by $1,300. So the reason we are debiting accrued wages by $1,300 is because when liability goes down, we debit it. And when liability goes up, we credit it. So what's happening when we debit accrued wages by $1,300? We're reducing the obligation that we originally had from 31 August 2018. Then you know that you have used altogether $4,500 from your bank account, which means altogether you have to credit the bank balance by $4,500. And the logic here is that when we credit the bank balance by $4,500, we are reducing our assets by $4,500, which is referring to the cash that we have in our bank account. All right. Now, what about the other $3,200 that we have missed, which is the difference between $4,500 and $1,300? That $3,200 refers to the wages expense that we have incurred, possibly on the first 3 days of September, and we also understand that we have paid $4,500 in total. So if $1,300 is going towards the liability we had from end of previous period, then it is obvious that the remaining $3,200 is going towards the expense for wages that we have incurred on the first 3 days of September. So anytime you have incurred wages or anytime you have incurred an expense for your business, we debit it. So debiting wages expense by $3,200. So altogether, you've got 3 lines here. So the first line, again, let me recall what's happening. So when we debit accrued wages by $1,300, we're reducing our current liability, which means we're reducing our obligation. And when our obligation goes down, we debit it. The second thing we're doing is to debit the wages expense that we have incurred for the first 3 days of September, which is $3,200, the difference which we calculated between $4,500 and $1,300. Lastly, we're crediting the bank balance by $4,500, which essentially tells you that the assets are going down because you have used them to pay off your wages. All right? Okay. So let's move to the second transaction that we've got on the 5th of September. So on the 5th of September, we accepted legal advice that debtor B. Smith will only be able to pay 20 cents in every dollar of the $1,200 owing. Okay. So what this means in simple words is that we have got a credit customer called B. Smith, and we have made a sale of $1,200 in the past. Now, what's happening is that this customer is unable to pay us now, which means that we need to remove this customer from the books. Now, this customer only confirmed that they will pay 20 cents on the dollar, which is the same thing as saying that they will be able to pay 20% of what they originally owe. Right. So the original amount that they used to owe is $1,200. So if we are recovering 20% of that, that means we expect to recover $240. Again, this is something that we expect to receive in the future. The customer didn't pay this $240 yet. They just told us that we can pay this amount at the moment, which equates to 20% of the original amount of $1,200. Now, the difference between $1,200 and $240, the amount that we expect to recover is $960, which we know that we cannot recover at all. And we can confidently say that this is a doubtful debts expense or a bad debts expense. Now, bad debts expense refers to loss in the economic value of sales transactions or that you're expected to receive in the near future. Now, first of all, you need to check if we had allowance for doubtful debts account originally. You can see that we do not have any information given for allowance for doubtful debts account in this question. So, which means that whatever amount has been confirmed as uncollectible, we can write it off straight away as bad debts expense or doubtful debts expense. So all expenses by default are debit. So what we are doing here is to debit the bad debts expense by $960, and then we credit the accounts receivable by $960, which is also known as the debtors control based on the past curriculum. Now, when we credit the accounts receivable by $960, we are reducing our assets by $960 based on the confirmation from this debtor B. Smith, who said that they will only be able to pay 20%, which is $240, and that means the other 80% or $960 is something we cannot recover at all. All right, so let us recall what happened. So we are debiting bad debts expense by $960, which means that we have incurred a loss for the business, and this loss is the economic value that we expected to get but not getting anymore. And then we're crediting accounts receivable by $960 because this is the loss in the asset or the credit customer we originally had. Okay, now I believe that is clear for parts A and B. Sorry, for the first two journal entries. So let's move to the transaction on the 6th of September. And this is a bit complicated, so make sure to focus and understand this thoroughly. Now, customer who had previously paid the deposit of $500 for a sale of $4,000 plus GST paid the remaining balance and collected the goods. All right. So what's happening? So we have got a customer who paid us $500 in the past, and we received that $500 cash in advance for services or products that we were yet to deliver back in that time. Now, this can be relevant to this prepaid sales revenue balance that we have got here, which is also known as the unearned sales revenue, and that is $500, which is what you can see under the current liability section. This refers to the amount that we received in advance, and this is a current liability because we didn't deliver our products yet to this customer. So back then, at end of 31 August 2018, this was a liability of $500, not an actual revenue that we have earned, if that makes sense. Now that we know on the 6th of September, we have delivered our products to this customer, what's going to happen? This amount of $500, which was originally a liability, the unearned sales revenue or the prepaid sales revenue, now will no longer exist in the books because we have fulfilled our obligation. So we have to reduce this liability, right? So when liabilities are reduced or when liabilities go down, we debit them. So that is what we're doing with the first line here. So debit unearned sales revenue by 500. All right? Okay. Now, altogether, the total value of the original sale amount is $4,000. Okay, so this $4,000 is the actual value of the sales or the revenues that we have earned, which we can report in our income statement as revenues that have been earned under the accrual basis assumption. Now, when we have earned revenues, do we debit or credit it? We always credit it. So that is why we credit the sales revenue by $4,000. So when we credit the sales revenue by $4,000, this is referring to revenues that we have earned, which means this is the amount that we can include in our income statement. All right. And when we include this amount in our income statement, this meets the criteria of accrual basis assumption, which calculates profit based on revenues that you have earned. All right. So when you deliver the products, that means you have actually earned the revenues, and the original sales value for this product was $4,000. Okay. Now, we also know that there is a 10% GST associated with it. So which means the GST on the sales would have been $400. So every time you have a GST on sale, how do we report this in the GST clearing account? Now, the GST clearing account by default is a liability account. Okay. Now, what does that mean? That means all the GST that we collect from our sales, or we expect to collect from our sales, are what we report on the credit side. The reason we report them on the credit side is because they are an obligation. We collect all this GST from our customers, and then we are obligated to send all this GST to the ATO. So in our books, in our ledger accounts, on the credit side, we show all the GST that we expect to collect from sales, or we have collected from sales. And on the debit side of the GST clearing account, we show all the GST payments, which essentially reduces our obligation that we have with the ATO. Now, because this GST clearing of $400 is relevant to the sales that we have made, it increases our obligation, right? And when our obligation or liability goes up, we credit it. So that is what we're doing here. So we're crediting GST clearing by $400. Okay. Now, the remaining balance, which is the deficit of $3,900 that we have included on the debit side, refers to the amount that we have received on the 6th of September, the cash that we have received on the 6th of September, and that is $3,900. Now, how does it make sense? Think about the original sales amount was $4,000, and including GST altogether, it would add up to $4,400, right? Okay. So in the past, if you have already received $500 in advance in the month of August, this means that on the 6th of September, when the payment is cleared and you have delivered your goods, you expect to receive $3,900, which is the difference between $4,400 minus the $500, all right? And when you receive this money, it obviously increases your bank balance. And when your bank balance goes up, your assets go up. And when assets go up, you debit it. So that is the whole logic behind why we are debiting bank by $3,900, all right? Now, let me just quickly walk you through this transaction again. So what really happened? So we had a customer who paid us in advance in the previous month of August, and the amount we collected in advance was $500. We didn't deliver our goods or services in the previous month. So what happened is when we prepared the balance sheet, we recorded this as an unearned sales revenue of $500 under the current liability section. Now, on the 6th of September, when we have fulfilled our obligation of delivering the product to our customer, this current liability, which we had originally recorded, no longer exists. And because now we have to remove this current liability of unearned sales revenue, we debit it. Because when we debit unearned sales revenue, we are actually saying that our liability or our obligation goes down. So we debit unearned sales revenue by $500. All right. Then we know that the total amount of sales that we have actually earned when we have delivered the products, the amount that we can confidently report in the income statement is $4,000, right? So we credit sales revenue by $4,000, which means that these are the revenues that we have actually earned, and this $4,000 is what is going to be calculated as part, is what is going to be used as part of your profit calculation. Now, the original sales transaction being $4,000 also has a GST component of 10%, which equates to $400. And when we are crediting the GST clearing by $400, it essentially means that we have made a GST on sales, and this is our obligation to the ATO, because every time you have a GST on sales, you are supposed to give it to the ATO. So what's happening is you're collecting it from the customer, and then you have to settle it against the payments that you have made, and then transfer the remaining amount to the ATO. So this means our obligation goes up, and when our obligation goes up, we credit it. So that is what's happening here. So we credit GST clearing by $400. So what's left at the end? At the end, we can understand that we are receiving some money again on the 6th of September, and that is $3,900. How did we find that? We know the total amount, including GST, would have been $4,400 altogether that we would have collected from this customer. In the past, in the month of August, this customer already gave us $500, so which means $3,900 is what we will collect on the 6th of September. So that is the amount that is going here. And when we're collecting this cash, it essentially increases our bank balance. And when bank balance goes up, we debit it because bank balance is an asset. So we are debiting bank by $3,900. Okay? All right. Now, part B requires you to explain the effects on the accounting equation if the transaction on 5th of September was not recorded. All right. So I'm not just going to only touch on the transaction on the 5th of September, but we will also look into all the transactions starting from the 3rd of September. So starting the 3rd of September, if I asked you what is the effect on the accounting equation based on all these journal entries, the 3 lines of entries that you've got, what would you say? Right. So what do we understand by the accounting equation? So the accounting equation is basically assets equal to capital plus liabilities, right? Okay. So when you're crediting bank by 4,500, it means that your assets are going down. When you are debiting accrued wages by 1,300, it means your liabilities are going down by 1,300. When you are debiting wages expense by 3,200, it means your expenses are going up, which means your profit should go down. And when your profit goes down, your capital should go down because profits are generally reinvested for next year of operations, right? So these profits, after any drawings have been taken, they basically get reinvested for next year. And this profit gets added as part of the capital, which is the main reason behind why we do closing entries and close revenue and expense accounts to profit and loss summary account. So if you have got an increase in wages, that means your profit should go down. And when your profit goes down, your capital goes down. So that is what is happening on the first transaction. What about the next transaction on the 5th of September? So on the 5th of September, we're increasing our expense, which is the doubtful debts expense or bad debts expense by $960. Now, when our expense goes up, our profit goes down. And when our profit goes down, our capital available for reinvestment the next year also goes down. When you are crediting accounts receivable by $960, this means your assets are going down. Okay? What about the 6th of September? So on the 6th of September, to begin with, we first debited the unearned sales revenue of $500, which is also known as the prepaid sales revenue. Now, when we debit unearned sales revenue by $500, we are reducing our current liabilities by $500. Then, when we debit bank by $3,900, it means we are increasing our assets by $3,900 because bank is an asset, and when assets go up, we debit it. And then we have got credit GST clearing by $400, which is again a liability. And in this case, you're increasing your liability by $400. Okay? All right. And then you have credit sales by $4,000, which means your revenues earned are increasing by $4,000, which means your profit should go up by $4,000, which means if your profit goes up by $4,000, your capital should go up by $4,000. Okay? So I believe that's clear with what's happening with parts A and B. Now let's move to part C and D, which I believe a lot of student faces issues with. So let's see what's going on. Right. Sorry. Okay. So in part C, DC Computing has replaced its van with a new van. And the old van was traded in for $10,000 on 30 September 2018. The new van was purchased on credit for $55,000 plus GST from Nifty Vans. So the first requirement is to find the depreciation on the old van for the month of September 2018 using the reducing balance method at 40% per annum. Now, where we can't find all the information relevant to the old van, so you look into the non-current assets section of the balance sheet. So you have been given the van at original cost of $45,000 and the total depreciation or the accumulated depreciation of the van up to 31 August 2018, which is $28,800, right? Okay. Now, when we use the reducing balance method of depreciation, how do we find the depreciation? We apply the given percentage on the carrying amount, okay? Now, how do you find the carrying amount? In this case, you have been given the carrying amount, but if you are not given it, how would you calculate it? So the carrying amount at any given point in time for any non-current asset is to start with the original cost and then subtract the total depreciation, which is also known as the accumulated depreciation. Now, the total cost, as you can see, given in the balance sheet for van is $45,000, and the total depreciation up to 31 August 2018 is $28,800, which gives us a carrying amount of $60,200. So this amount is what we are using here and applying the 40% per annum rate, which gives us a depreciation of $6,480. But this is on an annual basis, right? Because the 40% is an annualized rate. We are working with the business, which reports on a monthly basis, as the question clearly mentions it, I believe, in the third line of the first paragraph, all right? And also we can understand based on the month of August and the September transactions that we're doing. So if the total depreciation for one entire year is $6,480, that means on a monthly basis, this is $6,480 divided by 12, which is $540, all right? So this is the depreciation expense or the depreciation of the van for the month of September, okay? And that is $540. Now, so when you're ready, let's move to part D. And this is where things start to get more complicated. Right. Now we anticipate a similar question in the main exam for the disposal of non-current assets. And we are going to do this in multiple steps, which are something I recommend you can memorize, or at least know what to do so that you do not lose your marks. Now, the question in part D wants us to do the journal entries to record the sale of the old van and also do the purchase of the new van. So let's see what's going on. Now, what I recommend is every time you've got disposal of any non-current asset, I recommend you to follow all the steps that I'm giving you at the moment. So that way you do not miss out on any important information. So the first step I would recommend is to write off the accumulated depreciation of the asset that you have disposed. Write off here simply means remove the accumulated depreciation of the asset that you have disposed, remove it from your books. Right. Now we understand, based on the information given on the question, that the old van was traded in for 10 grand on 30 September 2018. On that basis, we can say that the disposal date is 30 September 2018. Now, what is the total accumulated depreciation up to 30 September 2018 for this old van? Originally, we had $28,800 from 31 August 2018. And then for the month of September, we have calculated $540 from part C, right? So altogether, this adds up to $29,340. Now, once you have got the total accumulated depreciation right up to the disposal date, what you're going to do, you have to write this off or remove it from the books. So when we think of accumulated depreciation, what do we understand? So accumulated depreciation is a contra asset account. What do we understand by a contra asset account? A contra asset account records the reduction for a relevant non-current asset account. And the relevant non-current asset account in this case is the VAT. And the accumulated depreciation basically records all the reduction in economic benefits that comes with the consumption and utilization of the VAT in the business for revenue generation purposes. So far, we have consumed $29,340 of economic benefits from the original old van. So now that we're getting rid of it because we're selling it, we have to remove this depreciation. Accumulated depreciation by default, as we understand, is a contra asset account, which means it is by default a credit account. Normally, assets by default are debit, but this is a contra asset, which records the reduction in another relevant non-current asset, right? So the default treatment for accumulated depreciation is going to be that when it increases, we credit it. For example, if you were to journalize the depreciation of $540 that we calculated from part C, you would debit the depreciation expense or the depreciation of van, and then you would credit the accumulated depreciation of van. So what you're doing there is you're increasing the expenses, and then you are increasing the accumulated depreciation of van by crediting it. But like I said, that now you are removing it or writing it off, you have to do the opposite of what you originally do when it goes up. So what you're going to do, you have to debit it to reflect that reduction, which no longer exists in the books. So debit accumulated depreciation of van by 29,340. Okay. And the corresponding credit entry is going to be the disposal of the relevant asset, which in this case is the van. So the credit entry is disposal of van by 29,340. So I recommend you memorize these steps. So basically, you start off by removing the accumulated depreciation of the asset that you've disposed. And the way to do that is to debit the accumulated depreciation account and to credit the disposal of this asset. Okay? All right. So now that is done, let's move to the next step. So in the next step, you need to write off or remove the original cost of the van from the books. All right. So the original cost of the van from the books, as you can see under the non-current assets section, is $45,000. All right. So if you have to remove this cost now, so van is an asset, and by default, assets are always debited. So if you're removing this cost component, now you have to reduce this asset for van, which means you have to credit the asset. So that is why we're crediting van by $45,000, where we are writing off or removing the original cost. And the corresponding debit entry is the disposal of van account again, and that is the $45,000. Again, I recommend you to memorize this step as well. So the first step is to write off or remove any accumulated depreciation so far up to the disposal date. The second step is to remove any original cost that you've got, okay? Right, now step 3 is where you calculate the profit or loss that you have made on disposal, okay? Now, right before the disposal, what is the carrying amount? So the carrying amount right before the disposal or at disposal on 30 September 2018 is simply the difference between the original cost and the total accumulated depreciation up to that point in time. So the original cost is $45,000, but the total depreciation is $29,340, which is basically $28,800 up to August 2018, plus an additional $540, which we calculated for the month of September, right? So altogether, it's $29,340. So on that basis, the carrying amount comes out to be $15,660. Now, the disposal proceeds for this old van was $10,000. How do we know? The question clearly mentions that the old van was traded in for $10,000 on 30 September 2018, right? So this means this is the disposal proceeds. Now, what we can understand is that economic benefits or the carrying amount remaining within the old van was $15,660, but we ended up selling it for less, which is $10,000. So we have made a loss, right? So that loss on disposal is the difference between $15,660 minus $10,000 and $5,660 is the loss on disposal. Okay? The loss on disposal is an expense for the business because it clearly indicates that this is a loss, which is the reduction in economic benefits, and that is why this is an expense. So every time the business incurs an expense, what do? We debit it. So that is why when it comes to the journal entry, you start by debiting the loss on disposal by $5,660, and the corresponding credit entry would be the disposal of van, which is $5,660. Okay? All right. So step 1, write off or remove accumulated depreciation so far up to the disposal date. Then step 2 is to remove the original cost. Step 3 is to calculate the profit or loss of disposal and then do the entry necessary. And now we're going to go to step 4. But before we go to step 4, my question to you is, if we had a profit, how would your journal entry change? If you had a profit, it means that you've made some money on this disposal. That means your income would have gone up. And when your income goes up, we credit it. So if you had made a profit instead of a loss, you would debit the disposal of that and you would credit the profit on disposal. Okay? So just remember that. Now, the next thing we do is record the purchase of the new van. All right. So we understand that the new van was purchased on credit for $55,000 plus GST from Nifty Vans. Right. So when we are buying this new van, our assets are going up, right? And the total value of the assets that are going up in the books that we're going to report under the non-current assets section for our balance sheet is $55,000 for this van. So when assets go up, we debit it. So we're debiting van by $55,000. And because this is a commercial purchase, there's obviously GST associated with it. And the GST is calculated separately, which is 10% off $55,000, that is $5,500. So we are debiting GST clearing account here. Why? Because what did we talk about earlier today? So every time we expect to collect GST from sales, we record it on the credit side because that increases our obligation we have with the ATO. Every time we expect to pay GST or we have made GST payments, that reduces our obligation that we have with the ATO. By default, GST clearing is a liability account. So if we expect to make any GST payments or we have made any GST payments, that reduces our obligation, therefore it decreases the liability, and that's why we would record it on the debit side of the GST clearing account, right? So that is why we're debiting GST clearing by $5,500. Then we're crediting other payables for Nifty. You have to be specific. Nifty vans, other payables by $60,500, which is the total amount including the original cost plus the GST. Now, why is it other payables or sundry creditors, for example, and not trade payables? We would write trade payables if you are buying inventory on credit. This is not inventory. This is the purchase of a non-current asset, which is a different thing, right? So trade payables refer to credit supplies of the business, credit supplies of inventory. But because this is purchase of an asset, we write other payables, and you have to be specific. You need to write other payables, Nifty vans, to get the full marks, right? Okay. What else is left out? Yeah, we have got one more pair of journal entry, and that has to do with the old van that was traded in for 10 grand. Now, based on the original purchase price of the new van, we understand that we would owe our other payables, well, the Nifty van, $60,500 in total. But if we have used our old van, which means we can reduce this amount by $10,000, right? So how do we journalize that? So this is the trade-in. So we debit other payables for Nifty vans by $10,000. And what is the logic here? Because altogether, we are supposed to owe this business $60,500, but we are giving them our old van, which, based on the arrangements we have done with this business, is worth 10 grand, and which means we can reduce the obligation with these guys by $10,000. And every time your obligation or liability goes down, you debit it. Then, what we're going to credit here, we are going to credit the disposal of van account, right? And that is by 10 grand as well. So this is the last step, and this last step has to do with the form of disposal proceeds. In this case, we gave our old asset away. In many circumstances, you could get arrangements where you are making the payment for cash entirely, and on that basis, the things would change, right? So what's happening here is that we are reducing our obligation by $10,000 by giving our old van. So we are debiting other payables with Nifty by $10,000, and this needs to be recorded in the disposal of van account, which means you have to credit the disposal of van account by $10,000. Okay. So on an alternative scenario, let's just say you got $10,000 in cash. So instead of recording other payables here, you would record back. Okay, because your assets would go up by $10,000. So that's the difference that you would expect to see if you get a different question with a different scenario. Okay. All right. Okay, so that's all for this question today. Now, what I need you to do is, if you find value in this video, go to the comment section and write that down, and also like this video and share it with your friends and subscribe to this channel. Also, in the description, you'll find a link to book a group tutoring session, a 90-minute group tutoring session on reconstruction and preparation of financial statements. We are expecting a 20-mark question, minimum 20-mark question for this topic, reconstruction and preparation of financial statements, which falls under the category of budgeting. And this lesson is going to happen on the 19th of October, Saturday at 2:30 p.m. This is only limited to 15 people. You will get the access to the comprehensive case study on signing up to this group call. And in this comprehensive example that we're going to do, it's a 27-mark example question that I've designed. In this question, we are going to prepare the reconstruction for GST clearing, for inventory, for accounts payable, accounts receivable, and many other things such as accrued expenses and prepaid expenses. And then we will use all these results to prepare our income statement, our cash flow statement, and our balance sheet. Lastly, we will also discuss the various ethical and financial considerations of the relevant case study that we're going to work with. So that's a very important question for your upcoming exam because it will increase your chances of getting a high mark in the main exam on 30th of November and also boost your high A term. Okay, so make sure to check the link in the description and book your call before slots run out. It's only limited to 15 people. So that's all for today's lesson, and I'll see you in the next video.